Welcome to our channel where we decode the complex world of investments for you. Today we dive into the fascinating world of REITs with the title 3 REITs to buy with the Fed cutting interest rates. In the financial marketplace, there's a particular type of investment that can offer consistent income and potential for growth. Real estate investment trusts, commonly known as REITs. These unique financial vehicles allow individuals to invest in portfolios of large-scale properties the same way they would invest in other industries, through the purchase of stock. But what happens when the Federal Reserve decides to cut interest rates? How does it affect REITs, and more importantly, your investment? In this video, we're going to explore this intricate relationship and highlight 3 REITs that show great potential in the face of dropping interest rates. We will delve into their unique characteristics and why they stand out in the crowd. Stay tuned as we unravel the mystery behind REITs and their connection with interest rates. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. To start off, we need to understand what REITs are. Imagine being able to invest in real estate without the hassle of owning, managing, or financing properties. That's what real estate investment trusts, or REITs, offer. They're companies that own, operate, or finance income-producing real estate, allowing investors to buy shares in these properties, much like they would in any other company on the stock market. So why should you consider including REITs in your investment portfolio? Well, there are several reasons. Firstly, REITs are designed to provide investors with a steady income stream. This is because by law, REITs are required to distribute at least 90% of their taxable income to shareholders annually in the form of dividends. So if you're an investor looking for consistent income, REITs can be an attractive option. Secondly, REITs offer the prospect of capital appreciation. Just like any other stock, the price of a REIT can rise over time, potentially leading to substantial profits for investors. Thirdly, REITs provide an excellent way to diversify your portfolio. Real estate is a distinct asset class that often behaves differently than stocks and bonds. This means that adding REITs to your portfolio can help reduce risk through diversification. Finally, REITs offer a level of transparency and liquidity not typically associated with real estate investing. Because they're traded on major stock exchanges, you can buy and sell REIT shares easily, just like you would with any other publicly traded stock. Now, you might be wondering, why would interest rates matter to REITs? Well, REITs are particularly sensitive to changes in interest rates. This is because they rely heavily on debt to finance their real estate acquisitions. When interest rates are low, it's cheaper for REITs to borrow money, which can lead to increased profits and higher dividends for shareholders. On the other hand, when interest rates rise, borrowing costs increase, which can squeeze profits and lead to lower dividends. But it's not always that straightforward. Other factors, such as the strength of the economy and the real estate market, can also influence how REITs perform. So while interest rates are an important consideration, they're just one piece of the puzzle. In conclusion, REITs offer a unique way to invest in real estate. They provide regular income, the potential for capital appreciation, diversification benefits, and liquidity. However, like all investments, they come with risks, and it's important to understand these before diving in. Now that we have a grasp on what REITs are, let's explore how interest rates affect them. Interest rates have profound effects on various investments, and REITs are no exception. You see, when it comes to interest rates, they're like the invisible hand guiding the market. They have a significant influence on all facets of the economy, from consumer spending to business investments and, of course, the real estate market. Now let's take a closer look at how interest rates affect REITs. Imagine you're a REIT manager. You need to borrow money to acquire properties, make improvements, and cover operating expenses. When interest rates are high, it's more expensive for you to borrow that money, which can eat into your profits. On the flip side, when interest rates are low, borrowing costs decrease. This means you can borrow more money and still maintain the same level of profitability. It's like getting a bigger bang for your buck. And when you can borrow more money, you can invest in more properties, which can lead to higher profits in the long run. But it's not just about borrowing costs. Interest rates also affect the income that REITs generate. Most REITs earn money from the rent paid by their tenants. When interest rates are low, businesses and individuals have more money to spend, which can lead to higher rents. This can boost the income of REITs, making them more attractive to investors. And here's another thing to consider: the relationship between interest rates and the stock market. When interest rates are low, bond yields tend to be low as well. This can make stocks, including REITs, more attractive to investors looking for higher returns. This increased demand can drive up the price of REITs, leading to capital gains for those who hold them. So, to sum it up, lower interest rates can be beneficial for REITs in several ways. They can reduce borrowing costs, potentially increase income, and make REITs more attractive to investors. Of course, it's important to remember that not all REITs are created equal. Some types of REITs may benefit more from lower interest rates than others. For example, REITs that invest in commercial properties may see a bigger boost in income from higher rents than those that invest in residential properties. Similarly, REITs that have higher levels of debt may benefit more from lower borrowing costs. But here's the important part. With the Fed cutting interest rates, certain REITs become increasingly attractive. They offer the potential for higher returns in an environment where other investments may be lagging. So, are you ready to learn about our top picks? We've combed through the market and identified 3 REITs that we believe are poised to benefit the most from the Fed's interest rate cuts. These are REITs with strong fundamentals, attractive yields, and a proven track record of delivering returns to investors. With the Fed cutting interest rates, certain REITs become increasingly attractive. Let's delve into our top picks. Now, to the heart of our discussion, the top 3 REITs to buy with the Fed cutting interest rates. First on our radar is the renowned Realty Income Corporation. Known as the monthly dividend company, Realty Income has a track record that speaks volumes. Since its inception in 1969, it has paid out over 600 consecutive monthly dividends. What differentiates Realty Income in the present economic scenario is its focus on retail properties with long-term net lease agreements. This implies the tenants, not the REIT, bear the property expenses, ensuring a steady income flow. Additionally, the majority of Realty Income's tenants are service or non-discretionary retail businesses, which are less prone to economic downturns and online competition. With the Fed cutting interest rates, investing in a REIT with a solid cash flow like Realty Income becomes even more enticing. Up next, let's focus on Digital Realty Trust, DLR. True to its name, this REIT deals with data centers. In this digital age, the need for data storage and management is soaring. Digital Realty Trust is home to over 200 data centers across 4 continents, catering to over 2,000 customers, including major tech giants. The appeal of investing in a data center REIT lies in the predictability of its income. Data center leases are typically long-term, usually spanning 10 to 15 years, and the high switching costs for customers further solidify lease stability. Moreover, data centers are a high-growth sector, with demand projected to increase as the world becomes more data-driven. This positions Digital Realty Trust as an attractive investment, especially with lower interest rates that can facilitate further expansion. Our third and last recommendation is Welltower. This REIT is a prominent figure in the healthcare sector, particularly in senior housing, outpatient medical, and health system real estate. With an aging population, the demand for senior housing and medical facilities is predicted to surge, positioning Welltower as a promising investment. Furthermore, healthcare is an industry that can weather recessions. Even during economic downturns, people still require medical care. This provides a degree of stability to Welltower's income. In fact, Welltower has consistently increased its dividend every year for the past decade. With the Fed lowering interest rates, this could potentially cut borrowing costs for Welltower, enabling it to acquire more properties and expand its income. To conclude, Realty Income Corporation, Digital Realty Trust, DLR, and Welltower, are 3 varied REITs that offer strong investment opportunities in the current climate of slashed interest rates. Each of these REITs operates in a different sector, retail, digital, and healthcare respectively, offering a balanced portfolio that can endure diverse market conditions. Moreover, all 3 have a history of stable, growing dividends, which is particularly appealing in a scenario of lower interest rates. These three REITs present dynamic opportunities for investors in the current climate of reduced interest rates. However, as always, it's crucial to conduct your own research and consult with a financial advisor before making any investment decisions. These are merely suggestions based on current economic trends and past performance, which is not indicative of future results. But if you're considering investing in REITs, these three certainly deserve attention. We've covered quite a bit today, from understanding REITs to identifying the top picks in the current interest rate scenario. It's been an enlightening journey, so let's take a moment to reflect on what we've learned. Firstly, we demystified what REITs are. Real estate investment trusts, or REITs, are corporations that own or finance income-generating real estate. They provide an opportunity for individual investors to earn a share of the income produced through commercial real estate ownership without having to buy, manage, or finance any properties themselves. Next, we dove into the relationship between interest rates and REITs. As we discovered, REITs are particularly sensitive to changes in interest rates. When rates are cut, borrowing becomes cheaper and property values tend to increase, which can lead to higher profits for REITs and, by extension, their investors. Finally, we shared our top 3 picks for REITs to buy with the Federal Reserve cutting interest rates. We looked at a diverse range of options, including a residential REIT, a retail REIT, and a data center REIT. Each of these offers unique advantages and potential for growth in the current economic climate. Remember, these are just our suggestions. It's crucial to do your own research and consider your personal financial goals and risk tolerance before making any investment decisions. We've ventured into the intricate world of REITs and interest rates today, and we hope this knowledge empowers you to make informed decisions about your investments. The world of investing is vast and varied, and we're here to help you navigate it. If you found this video helpful, please subscribe to our channel, give us a thumbs up, and share this video with your friends. Stay tuned for more insightful content on investments. Remember, knowledge is the key to wise investing.